Hey everyone, welcome to today's video. This will be the first video of the Value Investing Principles series, where we will learn the most important teachings from all the best investors of our time. Let's get started with what's perhaps the most important teaching of them all, which is so important that I actually had to make this video a two-parter. If you follow Warren Buffett or Walter Schloss's teachings, I'm sure you know the rule already. It may sound deceptively simple and extremely obvious, but it's one of the hardest rules to follow. The rule is, don't lose money. You might be saying, Shaylin, I obviously know not to lose money, and if I do lose money, it's probably going to be because of an accounting scandal, or it's some bad executive's decision, or some other person's fault. Well, I'm here to say that you're right. The cause of your losses will be from your worst enemy in investing, but that enemy is actually you and your human nature. Human nature has three main flaws when it comes to investing. First, most humans want to maximize benefits while minimizing the amount of work they have to do. This may sound like a good thing on the surface level, but it can be extremely dangerous when it comes to investing. Second, humans are social beings and struggle to be contrarian or alone in their decisions. Finally, humans are not good at deferring pleasure, which results in them taking significant risks to try and generate very high returns in the short term. Today, I'm going to give you 14 tips that you can use as a checklist to make sure that you never let human nature impact your investments and to hopefully ensure you never lose money ever again. The first tip suggests that we should always try to understand the intrinsic value of a company on a per-share basis before investing in the company. This tip is probably the most important in my list, but it is also the hardest for most people to follow. Why? Because it's the tip that requires the most work to execute correctly, and it's not always easy or simple to calculate the intrinsic value of a stock. Over numerous videos in a series I'm currently working on, we will look at the long and arduous process of calculating the intrinsic value of a stock the way the most successful investors in history do. I'll also explain how this method differs from the way traditional finance suggests we should calculate the intrinsic value of a stock. The second tip says that after computing the intrinsic value of a stock, we then want to consider what the market is currently offering to sell the stock for today. Without calculating the intrinsic value of a stock, you would have no idea as to whether the price offered in the market makes any logical sense at all. This is extremely important because we never want to fall for a value trap, which is a situation where we think that solely because the price of a stock has fallen, that it's suddenly a great deal. For example, Aurora's stock price has fallen 91.8% over the past year. Does that mean that it's a great deal and on discount right now? No, because we haven't compared the stock price to its intrinsic value. My personal opinion, backed by hours of research and financial modeling, is that Aurora's intrinsic value is currently below the 50-cent per share level, given a host of issues that the company and the industry are currently facing. That means at today's stock price of $1.01 per share, Aurora is still extremely overvalued, and I will not be buying shares even though the stock price has fallen significantly. The third tip is to examine the quality of the company's balance sheet before you invest any money into the stock. We want to make sure that we don't own companies that are over-leveraged according to the norm in the industry. I could explain why debt in a stable cash flow generating company leads to tremendous value creation, but that topic is long and detailed enough to be a video of its own. For now, we just want to make sure that the companies we buy are not holding too much debt, that there is a risk that they may have to dilute shareholders by issuing new shares, or that they have to sell cash flow generating assets of the company to meet their debt obligations. Both of these options will drop the intrinsic value of the shares, and if the market is being prudent, the share price will also fall. This could cause us to again lose money. This is a situation Aurora currently finds itself in, and they're diluting their shareholders at incredibly harmful rates. This is because it's difficult for them to sell any assets, given that goodwill and intangible assets make up a large piece of their overall assets balance. And overcapacity is eroding the book value of its tangible assets anyway, so if it does sell, it will have to sell at a significant loss. The fourth tip says that before we sell a stock, we should evaluate it again based on the current information. This is because value investors invest over the long term. If we buy a stock and it ends up moving close to its intrinsic value, this might be 3 to 5 years after we did our initial analysis. The truth is, our intrinsic value could now be outdated if lots of things have changed over the years that have passed. So we should update our analysis based on new company information, current interest rates, estimates about inflation, the current competitive environment, and other things. What's a simple framework we can use to determine if we should sell one of our portfolio companies? First, if the stock's current price appears to be above its intrinsic value, then we should definitely sell our position. If the stock's updated intrinsic value is above the current share price, we have a few decisions to make. First, is the stock delivering its returns by taking on excess risk through excess leverage? If they are taking on more risk to generate approximately the same returns as competitors, we should analyze the competitors and see if there's a better investment opportunity elsewhere. If they have leverage rates in line with the industry averages, it's likely just a competitive advantage the company is using to create additional value year over year, and we definitely want to continue holding this company. Second, do we see another company with a current stock price below its intrinsic value offering an attractive margin of safety? If we do, this is often a good opportunity to trim our other position, lock in some profits, and add some skin into the other position as it offers a more attractive potential yield. Finally, I wanted to add an additional thought. We don't want to be selling whenever any small news piece comes out that makes the future of the stock look potentially bad. We may want to factor it into our analysis if we believe it's significant, but we should remember that the market tends to overreact at times, and news companies are paid based on the clicks they get. So they often try and spin the worst case scenario possible to get your attention and your click. A classic example is the Facebook Cambridge Analytica scandal in 2018. So, did it harm Facebook's reputation? Yes. But does that mean we should have sold our stock? No. Unless we had no faith in management's ability to rectify the brand's image, or if we thought the company's customer base would have been so scarred by the news that they never returned to using Facebook's platforms. Never is the key word here, and if you want to understand why, I recommend watching my previous video, Why Bear Markets Are the Best Buying Opportunities, that showed why one bad year for a company means very little in the long run. So, if you thought the scandal would have had almost no impact on the product or the intrinsic value of the business, then you should have bought shares. And if you did, as you can see on your screen, you would have been rewarded handsomely. The fifth tip is to buy deep value stocks using a dollar cost averaging strategy with a final price target at the lows of the past few years. A deep value stock is one that is deeply discounted. However, this deep discount could be for a reason. That's why we consider using a dollar cost averaging strategy, because markets tend to be over pessimistic when there's turmoil in the stock and over optimistic when there's good things happening for a stock. Further, if the stock is deeply discounted, there could be very good reason for this, and we want to reduce our vulnerability because we don't want to lose money. For example, let's look at Starbucks stock. Its 52-week high was around $100 per share. Let's assume that this is Starbucks' true intrinsic value per share. If we want a 30% margin of safety, we would only be willing to buy the stock at a max price of $70 per share. However, let's say we have $500 to invest in Starbucks. We might want to look at its stock price history over the past few years to understand what the lowest prices were when the stock changed hands. Here we see that Starbucks traded for around $40 to $60 just a few years ago, so there may be some vulnerability in buying the stock at $70 a share. So we can use a dollar cost averaging strategy and buy about half of our position at $70 a share, and then the other half of our position at some price between the $40 to $60 range, if it gets to that range. There is some risk to the strategy because the stock could never make it to these levels. It could go to $65, then jump to $74, and you could find yourself having to fill the other half of your position at, say, $74 or $72. However, more often than not, the stock will traverse to its past lows if it's deeply out of favor, and we saw that this time around with Starbucks stock. The sixth tip is to reinvest your gains back into your account over the long term. Time is your best friend if you're a prudent investor. Let's say you have $1 million to invest today, and you're guaranteed 5% returns every year on your portfolio balance for 10 years. Many people would be tempted to take out the $50,000 every year to use. If the investor did that, they would end up earning $1 million over 10 years. And would also have their $1 million starting balance as their ending balance. However, if the investor reinvested that 5% gain every year, they would earn $1,653,297 over 10 years and have an ending balance of that plus the initial $1 million. Time in the market rewards the investor, and if you start taking out the 5% now to use every year, once your balance is in the 2 million plus range, you're looking at $132,665 that you can now withdraw every year, which is nearly 3 times the amount the other investor could use. The seventh tip is that stocks are better compounders than bonds. Bonds have limited upside potential if they're bought at par and held until the maturity date. The maximum yield you can get in this case is the coupon interest rate, if again you don't sell your bond. However, inflation erodes both the face value and the interest payments over time, thereby reducing your purchasing power. On the flip side, buying stock of companies with pricing power allows you to obtain a natural hedge against inflation, as these companies can raise their prices according to what the inflation rate is. All things equal, this increases cash flows, and since stockholders are part owners of the company and are entitled to these cash flows, their yield doesn't get eroded by inflation. An added benefit is actually that the fixed rate outstanding debt that the company has on their current balance sheet is devalued by inflation. So where bondholders lose, the company wins, and since shareholders are owners of the company, they also win. So part 1 focused more on the numbers and on the importance of research in mitigating losses, which aims to work on the first human flaw, or human nature flaw, that I mentioned. Part 2 will focus on the behavioral finance side, which deals with the second and third human flaws from the start of the video. I hope you really did learn something today and will be a lot more selective on your entry prices and stock picks moving forward. Also, I'm thinking of creating a series on the channel where each month I ask for the community to vote on a stock they'd like to see covered in detail. The stock that gets the most votes will receive a video and a financial model and report aimed at determining its intrinsic value and a good entry price. To enter a request for this series, simply just type in the comments below saying that you want me to cover this stock and give me a few reasons as to why you think it's an interesting stock for us to look at, especially during this particular month or for next month. And to put my money where my mouth is, I decided to start a portfolio for the channel. We can now share investment ideas, and the ones that meet our criteria, such as the ones in this video, will be added to the portfolio. The goal will be to never lose money, beat the market on a risk-adjusted basis on a per-stock basis, and sleep well at night in the process. If you want to see the 5 stocks I've added so far, leave a like and comment down below letting me know, and I'll include the stocks and the positions in the next video I make. Or if there's a lot of interest, I'll leave them in a pinned comment down below. I'm really excited to get the channel going, so please do share the videos with your friends and family, and let's get an awesome community going. Have a great day, everyone, and remember to always be eager to learn, willing to invest, and prepare yourself for success.